Saturday, April 7th, 2018, Monaco 64, home of alternative economics and contrarian views. I'm going to touch upon a controversial subject. Many people, even within the precious metals market, don't think it happens, and that's gold price suppression. Today, I'm going to prove to you how the New York Fed, with the help of the Vatican Bank, yes, the Vatican Bank, suppressed the price of gold in the mid-1970s. And then I'm going to look at some very long-term charts of gold and silver and show you how we are almost on the brink of a major breakout. Weekly and daily price action are frustrating in gold and silver. The markets, as I said, have been suppressed and manipulated, but I don't think the powers that be can affect the long-term cycles. And we could see some pretty interesting moves in gold and silver. I've got some interesting projections. Time-wise, it's difficult to say. But yeah, we'll look at that after we go through the gold price suppression. Before I go further, I'd like to look at an article by John Brimlow from JB's Gold Jottings, and it's on a website called investmentresearchdynamics.com, and it's from March 26, 2015, and it says, Paul Volcker said, gold is the enemy. So it goes on to say, JBGJ, or John Brimlow, from Gold Jottings, attended a meeting in New York last night at which Paul Volcker spoke. The fervor with which Volcker repeatedly asserted that gold was the enemy during his term as Federal Reserve Chairman was striking. So there you go. There's proof that Paul Volcker sees gold as the enemy. And you'd be surprised to know that the proof that I have for gold price suppression was back in 1975. Paul Volcker was still not Fed chairman back then. He was president of the New York Federal Reserve Bank. And prior to that, he was undersecretary of the U.S. Treasury when Nixon decided to close the gold window. I've read about John Exter, who was a good friend of Paul Volcker, who advised him at the time that he had two options. They could let interest rates rise to keep gold from flowing out of the U.S. They could reset the price of gold, or they could close the gold window. And Paul Volcker advised President Nixon to close the gold window. So Paul Volcker is behind all this gold story. So now you're asking, where is the proof? Well, here it is. Here's the letter. It's dated October 6th, 1975, from Amministrazione del Patrimonio della Sede Apostolica. Basically, that's the Vatican Bank, and it's addressed to Mr. Paul A. Volcker, President, Federal Reserve Bank of New York, 23 Liberty Street, New York, New York. And it goes on to say, Dear Mr. Volcker, I wish to tell you how much I appreciated your kind reception and the conversation we had in New York 1 month ago. So this is in the beginning of September. They had the conversation. Your letter of September 23rd has now come at hand. So now they had the conversation about suppressing gold, beginning of September, because this letter is October 6th, so a month ago. And then later on, he wrote a letter confirming it, putting it on paper. And the head of the Vatican Bank, I assume he's the head, Benedetto Argentieri, he says, your letter of September 23rd has now come at hand. I note that you confirm the opinion you expressed on the gold held by your bank on behalf of the Amministrazione, or the Vatican Bank. No, there is no objection to our selling it either on the official or in the private market. You also tell me that you are studying the possibility of enlarging the existing relations between your bank and the Amministrazione. So that's basically cold word that you want to like increase the selling. And I think by selling, he means leasing the gold. Leasing the gold to sell it in the market. And because would the Vatican Bank really want the Federal Reserve just to be getting rid of their gold? I don't think so. This is leasing from the Vatican Bank to sell it into the market and then buying it back to control the price. And he says, I thank you very much for the attention you are giving to this matter. That's rubbish. It's like Paul Volcker initiated this, and this guy from the Vatican Bank is making it seem that the Fed's helping the Vatican Bank. Hoping to see you again in not the too distant future. I remain yours sincerely, Benedetto Argentieri. You would think that the U.S. would be running out of gold back in 1975. Well, it wasn't running out of gold, but their holdings had dropped from around 20,000 tons in the 50s, and they were just above where they're supposed to be now, above 8,000 tons. You can see by this chart. So if they have all that gold, why do they have to borrow gold from the Vatican Bank to sell it? So to all those people who think the U.S. really has over 8,000 tons, we need to think again. So there's the proof that Mr. Volcker, president of the Federal Reserve Bank of New York, borrowed gold from the Vatican Bank. And you can see here in the chart that I brought up, I did a chart from the 1970s. It's a weekly chart. And you look at the end of August here, gold was trading above 160. And then in the first week of September, it dumped from 160 all the way down to 148.60. You see there's a gap there, and then gold keeps going lower. It bottoms on the 22nd of September when Mr. Volcker, around that time, he writes the letter. So gold, it looks like he did this operation in the beginning of September, and look how gold gapped down and went down, and then for another up until end of August 1976, gold kept going lower, but they weren't able to suppress it for that much longer. As you see, from 1976, September 1976 onwards, gold started going up, and then it went up all the way to above 800 in 1980. So there's proof there that the gold price was suppressed and manipulated. It had made a high at the end of 1974, just before the COMEX opened. The COMEX gold contract opened in January 1975, January 1st. So that really helped the suppression there as well. And the Vatican Bank, they provided the physical gold. Let's look at the silver chart. It's a quarterly chart going back to 1970, logarithmic chart. And this looks like the mother of all teacup formations, which is a bullish formation. How do you project the price move? Well, you take the bottom of the teacup, which I've taken it as 4, but it is a little lower there, but I've just made it easy to look at. So you take the $50, which is the top of the teacup, the top in 1980, top in 2011, minus the 4, that's the distance, and the move is an 11.5 time move. So for the objective, you take the top of the teacup, $50 times 11.5, and you get a price of $575. I will tell you what I think the gold-silver ratio will be later after looking at the gold price projection. The handle there, the teacup handle, has been forming since 2011, and it looks like it's just about to break out, that teacup, the handle. So that's the silver price, $575. It could be more like 600 if I use the the low there just below 4 in the 1990s. I've used $4 though, but that's not really relevant. So now the gold price. I've got the same kind of chart, quarterly logarithmic chart going back to 1970, and I've done a little bit of analysis of the 1970s bull market. So it took about 10 years. You had leg A from $35 to $195.50. And then you had the Volcker suppression, leg B, the correction. I'm not saying there couldn't have been a correction, but that probably was helped by that. Gold corrected 47.7%. And then from then on, it went leg C to $850 from 102.20. So a 731.7% move. And then we had the what was called the bear market of the 80s and 90s in gold, where gold basically hovered around 400. And I've done the same analysis for this bull market. We've got leg A, and you see that little arrow there I pointed. That's the low at $252. And that's just around the time that Gordon Brown, who was Chancellor of the Exchequer in the UK, pre-announced that they're selling the UK's gold reserves, half of the gold reserves, and that they're going to do it over a period of time. And you can see that gold was spiking there, and I think it was starting a bull market, but then it went down again, almost made a new low, but it didn't in 2001. So I've measured it from 1999 there towards the end of 99. So it went from 252 to 1920 leg A. In 2011, that was a 662% move. So it took really about nine years, but I think it was delayed by about 2 years because of Gordon Brown's manipulation. We could have been there earlier. So, and then we've had the correction that's lasted quite a long time, and I think that's due to gold price suppression as well. It could have been, the top might have been earlier if Gordon Brown hadn't manipulated the price, pre-announcing huge sales. But eventually the market did do what it had to. So leg B has been a 45.5% correction from 1920 to 1046. So very similar amount of correction that we had in 1970. So the move in leg A of the recent bull market from 2000 to 1999 to 2008 was 662%. The 1.6 is the proportion of leg C in the 70s to leg A. So it was that move was 1.6 times bigger than the 458%. It was 731.7%. So I've taken that to the present bull market. So 662% times 1.6 is 1,059%. So the leg C projection would be the low in 2015 of 1,046 times 1,059%. And I arrive at an objective of around 11,077 for the gold price. You'd think that it would take another 9 years for this to take place. And that's what I thought at first. We're going to have to wait from basically 2015, which was the low, to 2024. But I think it could be less time. And why do I say that? Well, because I think the bull market in the 70s took about 10 years. And this one that started in 1999 could take double. So that would be 2019. You could take it from 2001 when it almost made a new low, and it would be 2021. So I don't know. Or it could be even before. It could be 2018. We could have a huge spike, but I don't think so. So I think any time between next year and then even 2024, you never know, we could see gold reach that level. And I'll show you another chart here. More of a, I've zoomed into the recent correction of this quarterly chart. As you can see there, we're right on that line, ready to break out. The gold silver ratio. So if I take the high in gold, or the projection of 11,077, and divide it by 575, I get a gold silver ratio of just below 20. We've known that in the past, in precious metals bull markets in 2011, 1980, silver moves ahead of gold, and sometimes that ratio goes even lower. So it's not a perfect projection, because gold and silver might make their tops at different times. But roughly, I would say we could go to below 20 to 1, and even see that 16 to 1, which is the historical average. That's it. I think we're very close. Consider gold as savings. Trading, of course, is very frustrating, short-term trading. I guess you need to get into the mindset of the manipulators if you're going to trade paper gold. All of those like Bob Moriarty or Keith Weiner, who say there's no gold manipulation. I mean, isn't that enough for you? The Paul Volcker letter that he received from the Vatican Bank asking for gold, even though the U.S. had over 8,000 tons in 1975. If that's not enough for you, I don't know what is. So the suppression has been going on, and I think it's lengthened. It won't change the time of the cycle. So that's why I think it's not going to take another 9 years for us to go, or if you take it, or another 5 years to go to these projections. It could take less. We could see more gold accelerate. So that's it for now. If you enjoyed this video, please like, share it far and wide. Subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on Twitter. If you like to donate to the channel or buy some merchandise, I've got some Billy mugs and Billy t-shirts. It's all down in the description. And I'll talk to you later. Have a good weekend. Bye.